basically we are looking into derivatives and risk management. We say that derivative instrument is considered to be an instrument for risk management. That's true. We look from that perspective, we see that these instruments are used for managing or hedging the risk exposures, especially from financial instruments or various type of financial instruments. But then, since these are financial instruments and their value depends upon the underlying assets, there are inherent risk that is associated with these instruments, right? So, we had discussed different types of risk, which included market risk, liquidity risk, credit risk, yeah, maybe risk due to factors other than the financial aspects. It can be company specific or organization specific. So in a way, there is one way or other, these instruments are exposed to risk. So that's why we talk about the concept of risk management. Now let's look at what is risk management here. So as I said, the primary reason for risk management comes from the complexity of these instruments. Even in case of plain vanilla instruments like options, futures, there are risks that is associated with the price fluctuation in the underlying asset. That is price fluctuation or possibility of volatility with respect to the underlying asset. So what about the exotic or complex financial derivative instruments? We can imagine the kind of risk exposure those instruments would be having. Accordingly, the investors also would be bearing such extensive risk. That is why the concept of risk management is very important, especially with respect to exotic derivative instruments. Then the second thing is, as we all know, the money we invest, either as an individual or maybe as an institution, is basically coming up as our capital. It is the initial or maybe the substantial investment which we make towards making, towards the aim of making profit. So if this investment is at risk, that's not an ideal condition. We may not be under a position to bring more and more capital to expand our business if the risk exposure is very high and there are no genuine means for managing these risks. So that is why, since capital is a scarce resource and everybody intends to earn profit by investing capital, there is some kind of, or they require some kind of risk management strategy at place in order to encourage people to participate in such activity. So that is again another reason which requires risk management for derivative. Still, the inherent nature of derivative instrument, they are pretty riskier to a person who's very new to the market. In spite of that, when people are coming into the market and if they have a bitter experience, we can find the kind of popularity derivative instruments will be having in future. So in order to normalize the risk exposure, there needs some kind of risk management strategy, either at individual level or it can be at organization or company level. Then mostly, if you look into the market, derivative instrument market, it is technology-based trading online. Because when we are looking into stock market, at times still there are people who depend on conventional method for purchasing and selling of stock. You might be depending on a broker and all. But when you look into the derivative markets, most of it happens through online platforms. People who do their transaction generally come into the market and it's actually technology-based trading that is happening in the market. So as there is an advancement in technology happens, the complexity of dealing with derivative instruments also, there are possibilities that it can increase. So that again is one reason which underlines the need for risk management in derivative with respect to derivative instrument, because technology, there can be people can misuse technology, or because of lack of awareness regarding the use of these platforms, people can incur heavy loss. All these are some of the factors that can affect the performance in derivative markets. And of course, as we know, different types of market risk. It can be, as we said, it can be due to currency fluctuations. It can be due to fluctuations in economic indicators. It can be because of the political and other calamities within a country. So all these factors are actually giving a lot of risk exposures to derivative instruments. And moreover, when we look from in developed market, of course, they are almost stabilized with the accounting practices with respect to derivative instruments. But when we are looking from a country like India, these instruments as well as the market is pretty new. So the accounting practices are at its evolution stage. So there are many changes that are occurring from time to time, which may affect the type of computation, the value of asset, all these. So accordingly, there is also some kind of risk exposure because of this changing accounting practices. And along with that, the regulatory norms that are being enforced by Security Exchange Board of India and other regulators from time to time, they have some kind of impact on the pricing of these assets, these derivative instruments. So all these are bundle of risk that can affect the price movement of derivative products. So that is why it has been said that, like any other financial assets, derivative instruments also require some kind of risk management strategies, even though often it is quoted as one of the instruments that is used for hedging risk. Because of the nature of the underlying assets, because of the nature of the volatility of the market, there needs some kind of risk management strategies for these derivative instruments. So that is the first part, which talks about the reason for risk management with respect to derivative instruments. In our last few classes, we have discussed about types of risk exposures which are applicable to different types of derivative instruments. Right. Now, moving forward, the history of risk management with respect to financial assets, especially those which have or which had some features of derivative trading, it happened from 1970. Mainly after the breakdown of Bretton Woods Conference and the evolution of different regulatory bodies for managing the world trade. And of course, after the collapse of different economies, many of the nations, they actually went to something called as floating regime, which is associated with interest rate fluctuations. That is, many of them who were resorting to fixed rate interest regime, they converted that into floating rate interest regime, which is actually, they were dependent on, they wanted the economy to perform according to the market conditions. They opened up their financial sector to rather than into a free market, which is where the prices are determined based on the demand and supply, instead of controlling that in a watertight movement and bringing various regulations like fixed interest rate prevailing in the economy, or fixed market participants, or as you say, fixed trade rules. Instead of that, most of them started opening up the market for more trade and also better trade relationship. So along with that, there came many types of risk when the economy was opened up, when it was allowed to act according to the demand and supply or movement of prices. What has happened here is there were a lot of risk exposures which were based on fluctuation in the different types of assets. Say, for example, when the market was open, exchange rate fluctuation was very high because it was dependent upon the demand for that particular country's currency, and also the export and import happening within that maybe within that country. So the demand and fall in demand equally affected the exchange rate, currency exchange rate fluctuations. All these were the no, the reasons, or all these were the conditions that has led to the concept of risk management, even at national and international level. And there is something which became little more important when multinational corporations came into existence, when trade was happening between different companies operating across the globe. Everybody wanted to prove themselves to be a strong company, themselves to be a company resistant to much of the market factors. So they wanted better risk management. They wanted to expose themselves as one of the good company, or better company with fixed corporate goals and maybe objectives. So all these environment led to the evolution of the concept of risk management. So that this is actually the background of risk management. Now, India as a country, the concept of risk management at international level became very popular after, I would say, 1990, after the government decided to open its gates for foreign players. Because till that time, the economy was pretty under control through regulations issued by government, as well as RBI and central government from time to time. But after that, it went beyond that. It went beyond that control. It was also dependent on many of the regulations issued by world leaders across the globe. So that is the context where Reserve Bank of India, starting from the banking sector, they took serious steps towards bringing efficient risk management, starting with bank assets. We have heard a lot about the Basel norms. Basel 3 became little more stringent with respect to risk adjusted capital assets, what we call as capital to risk weighted assets, CRA. So the concept of risk management became equally important for public sector as well as private sector. So all these are the background of risk management. And risk management in derivative instruments, if you look from an Indian aspect, it's not so tight. It's still at a nascent stage, and still the actual risk management practices are, in a way, more or less are implemented at corporate level rather than individual level. Individual level, I don't think there is much risk management happening. The only thing that might be happening is only diversification of your portfolio. But at corporate level, many of it is happening because they are made accountable with respect to what is the level, kind of, or amount of risk exposure the company is having. So likewise, it is slowly evolving, but in the near future, if you want to attract more investors, there should be a correct system of risk management with every participant in the financial market. Moving forward, the risk management, the concept of risk management value chain. Risk management value chain, the basic objective is to arrive at the best possible value for your company as an institutional investor, for your portfolio as an individual investor. So when you're talking about a individual investor, it might be portfolio. For a company also, that is a portfolio, but that will go with the institutional investment goals. So we are just talking from the concept of risk management as a value chain for an organization. Often we know that organization can exist only if it is trying to create value for the investors. So that's a basic underlying idea behind risk management value chain, right? So first and foremost is it depends upon the corporate goals as well as how well they are being drafted to accommodate the risk factor in various levels of operations. And of course, the role of top management is very important for the purpose of risk management. They really have to devise various strategies for managing different types of risk that is being faced by that particular company, and that is almost customized, because no two companies will be faced, even though they operate in the same market, maybe with similar products, maybe with similar turnover, but still the risk exposure would be customized. It will be it needs to be addressed on a individual basis. So that's why we say that every company should have a management that is totally put responsible for managing the risk of the company. In big companies, especially those coming under the listed category, they would be having a team who are exclusively looking into the strategic goals as well as the management of risk associated with that company. Then the third thing that is like beats in a chain, the third thing is there should be a proper information system that is helping the company to manage the risk. Now we call that from the perspective of MIS, Management of Information System, which is basically using technology. You're trying to manage your information. Every now and then you are updating your information depending on the changes that is happening in your market and the environment, and accordingly you are taking mitigation steps. Now this is the right time. As you can see, some of the results of some companies, they were able to manage the risk in a better way in spite of all these challenges they faced in this particular calamity. But some companies, they could not, or they could do nothing because they did not have a real risk management system in place. So that's where we talk about corporate goals. Yes, and your risk management system is intertwined to that goals. At the same time, you have a team who are looking into how well you can manage the risk exposures through proper supply of information. And of course, every company will be choosing its own risk model. Say, as you say, some of the companies, they are ready to take risk by bringing more and more innovative products. Because basically, last time I happened to see a video that has been circulated. I don't know whether that was based on a presentation made by the Israel foreign trade minister, and he was talking about how well they could invest in cyber security. When and they were comparing with different countries, they were talking about the different investments which are made by countries across the globe in cyber security and also in IT based startups. And the country has made considerable level of investments with respect to cyber security startup companies as well as IT based startup companies, and that's a good move. It's a risky move, but that's a good move because they are aiming at an economy that is based on IT, that is based on technology. And they say that no other, even the number one quoted company, a country, US, has not made an investment of that much amount in cybersecurity. So they quote that as one of the advantage for them, and many of the nations like us are trying to associate with Israel for getting the benefits out of these startups. That is something that the country claims, but that's a decision that has been taken by, that's a choice that has been taken by that country. They have a lot of risk involved in that. Technology is something which is a bit risky, because every now and then when somebody brings an innovation, the pace of technology will change, the type of technology used will change. So as you go with updating your system, that's something which requires continuous updation. So there is a choice, there is a risk involved, but you really have to have a model. Suppose some companies are willing to take more risk, some moderate, some maybe they are risk averse. They may not be pretty sure about what's going to happen. They may not have a full-fledged R&D department, so they are not going to take up immediate steps, trying to locate the new type of demand coming into the market, all that. That depends upon the choice the company has made. But some of the best companies across the globe are the companies who have made risky choices based on the analysis. They were dare enough to come up with new ventures. So that is something which again is adding value to your company. And then, of course, once you implement it, if you have a risk management system in practice, if you, in fact, R&D department is an essential ingredient of risk management system in your company, because every now and then, every company, every top company in India is having an R&D department which is trying to overcome the demand that is happening because of the change in the demand or change in the technology or change in the consumer pattern, or taking or considering the new opportunities coming in the market, all these. So what I'm trying to talk about is risk management value chain is a decision that is taken up by a company from the start, and it is intertwined to its goals, and there is a team who are mainly totally engaged into such type of risk management activities, and it's a continuous process. Say that might be that a company, say banking sector, you can see a lot of mergers, acquisition happening. That is a risk management strategy. The banks are facing risk due to diversified customers and also no, maybe disconnected markets. So they want the markets to be coming under one umbrella. So many of them are going for no mergers and becoming big leaders within different country or maybe within the global economy. So that is a different model where that's a choice of risk management model. They want to manage their risk due to loss of business, due to loss of customers. So that is one method being. So that depends upon the corporate goals. And ultimately, all these should be answerable to the concept called value chain. What is the value that is being created through these operations, right? So that is about risk management, value chain, and then uh, this is something which you know very well. The approaches to risk management that you can take. One is I don't bother. See, when I look at my portfolio, I make the investments, I forget about it. That's because that's only a small portion of my investment. That's only a part of my investment. The amount might be small. Then I can go with such passive investment risk management strategies. But that is also, I would say, in this volatile market, that's not a good strategy. But it depends upon your choice. And the next one is when you are dealing with a lot of money, when you are making huge investment, risk management becomes an integral part. And when you are handling money which involves the interest of different stakeholders, public bodies or public limited companies, they are handling money which includes the interest of different stakeholders starting from shareholders. So they should be in a position to cover and manage their risk properly. They should be able to cover up their risk in whatever possible way. So these are the basic two approaches, but you can lie in between. Say you can lie in between, like occasionally you are revising your portfolio, occasionally you are diversifying your portfolio, so you are somewhere in between, do nothing and cover everything. Somewhere in between, based on the market performance. Say, for example, now many of them go for selling their stock and purchasing from the start because the market went up. Now there is a possibility that it can crash. So people are trying to slowly sell their stake, and when it goes down little, they can buy it. So likewise, so that is in between approaches to risk management can be do nothing, do everything possible, and in between also you can trade. So that's what we call about approaches to risk management. And now you are very familiar with this concept, value at risk. In India, this concept became very popular after Reserve Bank of India introduced that as a mandatory norm for banks in India. Banks in India had to come up with the concept, the so-called concept of value at risk on a, the day was 10, for Basel, they laid us with a maximum of 10 days and with 99% surety. So, what do they mean by that is banks are handling public money. So they should be in a position to know what is the possible kind of loss they can expect when they are depositing, when they are investing their money with banks. So banks now, conventional kind of banking involved only, no, putting your money in money market, or maybe lending to some of the corporates. But now the modern banks, they go with investments in capital market. They have a lot of risk exposure to different types of volatile instruments. So the Basel III has made it mandatory that there are, along with war, there are many other risk measurement tools that are being used by banks, but value at risk, or CRAR, the risk weighted asset concept that was introduced, and the concept of value war became very popular among the researchers and academicians as well as the practitioners. But theoretically, if you say, the concept was developed in 1993, and it came up, basically it came up as a measure to exhibit the kind of risk that is being taken up by an investment company. That was a concept. And later the concept included incorporating different types of market risk, but initially there were only one aspect that was taken care, that is fluctuation in the price. What were the reason for the fluctuations did not have much importance during the evolution stage. But now, as you can say, yeah, I have put the war as a quantification of market risk into single indicator, one single indicator. As you all said when we were presenting, it's one single indicator which can say what is the maximum possible loss that can happen to this particular investment in a time period, maybe in 5 days or maybe in 10 days. And it also says with what surety you are saying that. Is it 100% or is it 99% or is it 95%? So in that case, if it is the case, mostly people prefer 100%, but 100% means there is no risk, right? So normally people go with 99%. So in this stated period, say if it is 10 days, okay, 10 days, the chance of having a loss more than as you say, the quoted amount in 10 days is 1 day. 1 day there is. That's why we say 99%, right? So in this 10 days, for 9 days, it's like this. The maximum possible, it can be said in that way also, okay? The maximum possible loss which can happen is this much. For 9 days, it will be less than that. Then 1 day, you're not sure. It can be more. That's actually the kind of analysis that is being given by war measurement. Now, war incorporates many aspects, including the economic indicators, but that quantifies that into one single measure. That's the advantage of war, and the greatest disadvantage of war as a measure is it seldom or it is very difficult, extremely difficult to bring outliners into your calculation. Outliners means extreme variations from the performance can happen. When there was a fraud in Satyam company, there was an extreme variation. When the possibility of war between Israel and Palestine happened, the market, there were extreme variations for some of the companies, some of the domestic companies. So that outliners normally is not captured effectively in a war measurement. That's why people often say that you use many other risk measurement tool, or maybe customized risk measurement indicators along with war as a tool. War in certain cases, as I said, for the case of bank, it is mandatory. For public sector companies, it is mandatory. It's been mandatory just to exhibit that. But it is advised that you go with some other measures along with war to bring a sophisticated picture of the possibility of loss in your company. Now, as I said, no, this our Aparna had presented in our presentation this statement. This is actually something which talks about I am X percent state certain. X percent normally preferred is 99%. 99% that there will not be a loss more than, say, imagine the amount is 10 lakh. There will not be a loss more than 10 lakh in the next. Most preferred is 1 day. Okay, it can go up to 5 days or 10 days, but people do not prefer more than that. So 99%, which means there is 1% possibility that it can go above, and that depends on many other factors. That's the essence of war as a measurement. Now, criticism, as I said, uh, even though we say that quantification is with a unique number, there are many other parameters that are defined with, in many cases, with no possible definition. Many other factors that are defined very clearly. See, for example, n days. How do I fix the number of days? Then when I'm talking about confidence level, how do I fix this 99%? Different methods use different logic. 99% I'm sure, 95% I'm sure. It's all simulated figures. And if there are extreme conditions, of if there are immediate changes, such simulation models will not capture it. So that is why we say that even though it is single statistical figure that exists, that exhibit the maximum possible loss, there are many indicators or parameters that are included under that single figure. That's considered to be the problem of war as a measure. That's been quoted, and in many cases, that's why it is advised that war should be supported with other risk management tools. Okay. All right. Then assumption of normal distribution. Again, assumption of normality is pretty impossible in a volatile market, because there would be peaks, there would be downfalls in a volatile market. It will not happen like a normal market. Sometimes there would be skewness, there would be kurtosis, which is not the assumption of war computation. That again is again another problem with the war measure. And the commercial confidentiality, because many of the factors companies will not expose themselves, because if they go with computation of war also, they will try to eliminate some of the factors which they are planning because of the confidentiality of that matter. Maybe they are going for future investment, they are going for starting up a new plan, or they are trying to enter into a new market. They may not expose such data because of its confidentiality, because that is a highly competitive data. Right. So that may not happen. So accordingly, war as such will be handicapped to that extent. How far you have made it public, all the information, that would be one ingredient for computing your war. That is, if you are in a, say, as you say, in a Monte Carlo method and all, you use as possible, as much as possible, you include variables to your simulation model. You include different indicators. But if you're purposefully eliminating some of the indicators, your model will not be sophisticated enough to predict the actual loss. That again is considered to be one of the laws of, as we say, the war method. Okay. Now, This is something which talks about the different methods of computation of war. Most of you have presented that there are basically three methods: historical simulation model, model building approach, and Monte Carlo simulation method. Historical simulation model, as you all said, it is the simplest method which just takes care of the past prices. And the belief is history is going to repeat. So past returns happens to be a good guide to what will be happening in the future. So hypothetical portfolio is created based on the past return. That's just a model based on the past performance. Now, the greatest problem with this model is if you're a new company, what is the data in your hand? You don't have a past record. So how do you go with this method? That is one of the problem. Another problem is always it cannot be said that past is going to repeat. There are many other factors. If that is the case, everybody could have made abnormal return in the market. That is not happening every time, every moment. There are certain cases that is falling in a different way. So that is the drawback of historic simulation method, but still it is well accepted among the research community because of its simplicity. Now, model building approach, broadly, it can be categorized into two. One is linear model, another one is quadratic model. Quadratic model is normally suitable to derivative instruments, especially those instruments which involve a lot of volatility factor like options, where the market is very volatile. And linear model, it is also, even though not as simple as the historical simulation model, but they are simple model that takes care of mean and standard deviation and try to establish the correlation between the returns. So that is between they take the difference, okay, difference in returns over a period, and also they try to establish the relation between time and returns, the covariance and variance between the relation between the two return movement. So that's the basic logic in model building approach. We are going to solve some exercise on that. And again, here, the assumption is there is a linear relationship in this variance or in this return moment. It tries to exclude the skewness, okay, the extreme movements or the outliners. It is excluded, which is considered to be the greatest disadvantage of linear model. But instead of historical simulation model, historical simulation is just a hypothetical situation you're predicting. But here you are establishing little more as a model, explaining the relationship using mean and standard deviation. So you are going with a statistical analysis to explain the relationship. So little more higher end than the basic historical simulation method. Now, the basic disadvantage of linear model is it does not consider skewness. Quadratic model, it considers skewness, or as you say, gamma, the volatility measure. Gamma is a Greek simple, and here in this context it takes care of volatility, and as it takes care of volatility, it takes care of small variations or many other factors. But the limitation is, as the number of factors increases, the computation becomes little more difficult, factors leading to volatility. Okay, so if you consider 2 or 3 factors, computation may be easier. But if you have 50 to 60 factors or variables, the computation becomes pretty difficult, even through a computer, even through a system, IT-based or computer-based computations. Still there we face problem. So model building approach includes linear model as well as quadratic model. Linear model, as the name indicates, the basic assumption is there is a linear relationship, a line across. If you draw a line, the return will flow near to that line, somewhere near to that line. But if that is not the case, the model becomes a flop. That's a major difficulty in that. Now, Monte Carlo simulation method is the most sophisticated method in computation of war. It, as of now, okay, in future maybe there are many other methods that might be coming, but Monte Carlo simulation method as of now is the most simulated method for computation of war. Why? Because it is simulation based on all future possible events that can happen in the market. So you arrive at different values for your war. It cannot be manually arrived at. It's computer based, software based, but it computes different war values. Okay, different war value at risk. Values based on different future conditions that can happen. It will incorporate if this is the GDP, if this is the inflation rate, if this is the interest rate fluctuation, if this is the kind of wallet. Likewise, they incorporate different conditions and arrive at different values exhibiting what will be. If the condition is X, yes, this is the possible loss. If the condition is Y, this is the possible loss. Likewise, different. So an investor is given with different possibilities, and he can decide whether to go for it, because he or she will be having, the research department will be having their own intuition. Yes, the case of X is going to happen, or the case of Y is going to happen. And then they can evaluate, does the company have a risk appetite to bear so much of risk? Are they prepared enough to go for such risk exposure? Because it says maximum possible loss, maximum possible capital loss in all these conditions, right? With so much surety. So that is the beauty of Monte Carlo simulation method, where you are simulating using different algorithm. Now but as even with the use of AI, still the system will be failing at times. The algorithm use will be failing at times. And there, the Monte Carlo simulation method also will be failing, because if you knew very well when the financial crisis is going to happen, if the Monte Carlo simulation method could exactly predict that, there will not be any problem in the world economy. But that's not happening. So there is some missing in spite of all tightly packed simulation methods. And that is an inbuilt problem with every method, and that basically depends upon how far or what is the justification being made by the individual investor or institutional investor. And also you will have to look into many factors like the current happenings, and you have to incorporate everything very well into your process, into your system. So the Monte Carlo simulation method, here it's a simulation which is created at by incorporating every possible factor that is going to affect the price movement, that is going to affect the return expectation. Right? So these are the three methods in war computation. Now, there is something which we have to know more about, the risk management. See, in spite of all these, risk perception or profile of the investors is one factor that is going to affect your risk management methodology. So, for example, sometimes gender-wise, as of now, the recent studies also, they prove that uh, females are supposed to be little more risk averse than male. That's a study, okay? I'm not saying that because maybe because of the lack of experience or lack of understanding, or maybe by birth or by gene they are little cautious, what can be. But the risk averse nature, or the intensity of risk averse nature generally are high among female. So that's gender aspect there. Marital status, maybe when you are younger, when you are not married, your risk appetite can be a little more higher. because you do not have to support the number of supporting members is an important factor for you to go with the kind of risk exposure you have. So marital status can be a factor. Age, at younger age, you have n number of years for earning. But you imagine a person who is retired, who does not have a regular income, the kind of risk exposure he can take will vary definitely with a person who is still earning or who is having 10 to 20 years of earning age, right? So then level of education definitely. No, level of education means level and the kind of education you have, because even after being awarded with the highest qualification of a university, that is PhD, still you may not have an appetite to take risk. You will go with the conventional bank deposit or pension, or maybe the LIC, life insurance products, all that, because you did not have that kind of education which gave you insights into different types of investment opportunities. So that is very well interrelated with the financial knowledge you have. And of course, social and cultural factors also. Keralates are supposed to be little more cautious investors, whereas when you see there are certain communities who, from the very childhood itself, they are into the habit of saving money and investing. So they are, or maybe they have little more aptitude towards taking higher risk, investing their money, waiting for return, going with the no or application of the principle of compounding, going with a lot of diversification in the investment portfolio. So all that, and finally, to conclude, I said. Either you can go with no risk management or you can go with complete risk management, and that happens in these groups. Risk averse people means they are seldom, or they do not go with going with any kind of risk exposure. They want to be in a comfortable zone. But what we have to understand is, now in current perspective, no such investment opportunity is there available to an investor which is 100% safe. Nothing like that. There is no concept like that in this open market, in this globalized market, free market transactions. But still, there are a lot of people who are risk averse. They don't want to take risk. They want to minimize the risk as possible. That is one category. Risk neutral means people who don't care, or maybe because of lack of awareness, or maybe they are not alert, or they don't bother. They have plenty of money, which they have earned, and they can afford to lose some of it. Maybe that some people are neutral to risk, but you don't find such category all through the life. At certain stages of life there might be neutral, but the habits can change. And risk seeker are people who are ready to take risks to earn extra return, to earn higher return. They are broadly categorized under the category of entrepreneurs, or maybe innovative traders, or as you say, people who are ready to go with or implement their innovative ideas, either in case of financial investments or maybe in case of capital investment. So broadly, you can classify them there, but these are not watertight containers. Some people may be at the later stage, they may turn to be risk averse, but at the earlier stage, they might be risk seekers. It can happen in the reverse way also. We might have seen people who have started business at the age of 50 or 60 after retiring from the regular job. So they come under the opposite category. So these are, it varies. It depends upon the experience, the exposure, the opportunities you have, all that. So generally, the risk management can be discussed under these different heads. So to conclude, in our class, we started with why we have to go with risk management with respect to derivative instruments. Then we talked about the type of risk exposures. we discussed the concept of VAR, value at risk, which is a quantitative measurement of maximum possible loss that can happen to an institution or an individual. We also discussed about the profile or how risk management, or what are the factors that lead to the concept called value creation through risk management, and what are the factors that can affect the attitude of investors towards risk. So that's all about. And if you want to ask any doubts, you can ask me now. Tomorrow we will start going with doing exercise in this area. That is basically, we are not going with complicated exercise, but a basic understanding is needed. So we will do some simple problems in Monte Carlo. Of course, that is difficult for us. We do not have a software, but the other two we will do. We will try it. We'll try to work out how do we go with this variance and covariance method for VAR computation, right? Monte Carlo, of course, you can do, because there are many softwares freely available where you can just experience how it happens by surfing to the net. That is possible. So, if you have some doubts, you can ask me. Anyone on what I discussed? It's very important part. The whole what I discussed is part of 2 or 3 essays. You have to write. It can come as 2 or 3 essays. The module looks very small, but the question would be very big, because these are the basics underlying why you should go, or how you should go with derivatives and risk management.